Good evening, everyone. I'm Saurabh Paliwal from Biocon Investor Relations team, and I would like to welcome you to Biocon's earnings call for Q2FY24. I would like to indicate that all participants will be in the listen-only mode, and there'll be an opportunity to ask questions after the opening remarks conclude. Should you need to raise questions, please use the raise hand option under the reactions tab of the Zoom application. We will call out your name and unmute your line to enable you to ask the question. While asking, please begin with your name and your organization. Please note that the chat box is disabled, but you can raise any technical concerns by sending us an email to investor.relations@biocon.com. I would like to bring to your attention that this conference call is being recorded. The recording will be made available on the website within a day, and the transcript will be made available subsequently. Today, to discuss this quarter's business performance and future outlook for the company, we have Dr. Kiran Mazumdar-Shaw, our Executive Chairperson, Mr. Peter Bains, Group CEO, Mr. Siddharth Mittal, MD and CEO Biocon Limited, Mr. Shihas Tambe, MD and CEO Biocon Biologics, along with other senior management colleagues across our business segments. Before we begin, I would like to point out to everyone the safe harbor related to today's call. Comments made during this call may be forward-looking in nature, based on management's current beliefs and expectations. They must be viewed in relation to the risks that our business faces that could cause our future results, performance, or achievements to differ significantly from what is expressed or implied by such forward-looking statements. After the end of this call, if you need any further information or clarifications, please do get in touch with the team. With this, I would like to turn the call over to our chairperson for her opening remarks. Over to you, Kiran.
Thank you, Saurabh, and good evening, everyone. Let me begin by wishing everyone a very happy Dhanteras and a very, very happy and prosperous Diwali. Let me wish you all health, happiness, and prosperity in your homes, and let's hope that the year ahead is going to be very prosperous for all of us and for our country. I would now like to provide you with a broad overview of the group financials. Total revenue for the quarter was 3,620 crores, up 52% year on year. Revenue from operations increased by 49% year on year to 3,462 crores, with biosimilars revenue almost doubling, of course, reflecting the acquisition from Viatris. Research services delivered a strong revenue growth of 18%, while generics grew by a modest 4%. Core EBITDA grew by 35% to 1,100 crores, reflecting a healthy core operating margin of 32%. Let me now introduce two senior executive appointments. Mr. Kedar Upadhyay, who joined Biocon Biologics as the new CFO. Kedar brings over 23 years of global financial leadership in the pharmaceutical industry. His deep experience and expertise will enhance our ability to unlock and drive future value in Biocon Biologics. Secondly, I would like to welcome back Mr. Peter Bains, who, as you know, assumed the role of Group CEO of the Biocon Group in September. Peter will be responsible for supporting me in evolving strategy and driving synergies between the three group companies. And this is with an aim to maximize their combined value for all stakeholders. Peter's comprehensive understanding of the Biocon Group, coupled with his extensive global leadership experience and successful track record across the biopharmaceutical sector, will enable us to capitalize on the shared value of our three businesses and add impetus to the group's growth trajectory. On that note, and as a part of Peter's new role, I would like to hand over the floor to Peter, who will lead the earnings calls going forward. Over to you, Peter. Peter, this is over to you now.
Peter, you're on mute, Peter.
Okay. Thank you, Kiran, and good evening, everybody. And let me first of all say how delighted I am to be rejoining Biocon. It's a real privilege and pleasure, and I'm very excited to be rejoining the group at such an exciting and dynamic stage of its evolution. Before discussing business performance, I want to take this opportunity to welcome other new leadership hires in the group. In Biocon Biologics, we have 3 appointments. Dr. Uwe Gudat joins as the Chief Medical Officer. Dr. Arlene Wolny joins as Global Head of Regulatory Affairs. And Mr. Ramprasad Bhatt joins as Head of Branded Formulations in India. And at Biocon Limited, Mr. Nitin Tiwari has been appointed as the Head of Quality for the generic business. Let me now expand on Kiran's opening view on the performance for the quarter. As Kiran stated, total revenue and core EBITDA for the quarter were 3,620 and 1,100 crore respectively. R&D spends for Q2 stood at 264 crore as compared to 242 crore last year, corresponding to 10% of revenues excluding Syngene. The R&D investments are largely attributable to advancing BBL's strong pipeline of biosimilar molecules, as well as developing new peptides with a focus on GLP-1s in our generic business. The benefits of these investments in research and development are expected to play out in the coming years. EBITDA for the quarter was up 68% at 900 crore versus 535 crore last year, with an EBITDA margin of 25% as compared to 22% last year. Depreciation, amortization, and interest increased by 376 crore over last year, primarily related to the biosimilar business acquisition cost. Consequently, profit before tax and exceptional items stood at 238 crore, marginally down from last year. Net profit for the quarter before exceptional items stood at 142 crore as compared to 168 crore in the previous year. Exceptional items during the quarter amounted to 16 crore, net of tax and minority interest. These relate to the reversal of production-linked incentive scheme accruals of the last fiscal consequent to the cap on annual claim allocation, as well as transaction cost of the proposed Stelis facility acquisition by Syngene. Exceptional items last year amounted to 122 crore, and therefore reported net profit stands at 126 crore as compared to 47 crore last year. Let me now turn to discuss the generic business segment performance. Generics reported an operating revenue of 676 crore for the quarter, a growth of 4% over the same period last fiscal. Core EBITDA margin for the quarter stood at 23%, with profit before tax at 66 crore, representing a profit before tax margin of 10%. Revenue performance for the quarter was driven by continued traction in the US generic formulation business through additional volumes in statins and recently launched products, and most of the world market expansion. On the API side, performance was muted due to phasing of supplies because of a planned maintenance shutdown for one of our key products, as well as pricing pressures. We made 2 significant announcements during the quarter. First, we announced a partnership agreement with Juno Pharmaceuticals, a specialty pharmaceutical company in Canada, for the commercialization of liraglutide for the treatment and management of type 2 diabetes and obesity in Canada. And secondly, as part of our plans to strengthen our foothold in the North American market, Biocon acquired the oral solid dosage US manufacturing facility of Iowa Pharma, located in New Jersey. The acquisition of this US FDA-approved facility, our first in the US, will strategically enhance and complement Biocon's existing manufacturing capabilities. The facility will enable the immediate addition of oral solid dose capacities for new products earlier than planned and ensure continuity of supply through the diversification of our manufacturing infrastructure. The facility's employees have transitioned to Biocon, and the process of qualifying the site for some of our products has already been initiated. We are pleased to see positive outcomes on the regulatory front, with several generic formulation approvals obtained in the quarter, 1 in the US, 2 in Europe, and 4 products in most of the world markets. Further to this, we've received 2 API product approvals, each in the United States and in Europe. Regarding our capital expenditure program, we crossed an important milestone in the quarter with process validation at the company's greenfield immunosuppressant API facility in Visakhapatnam, which is now successfully completed. We now expect commercial supplies to begin in full year 25, post-qualification of the site by global regulators. This new capacity for immunosuppressants will enable us to diversify our manufacturing footprint and address the growing demand for these products globally. In the second half of the year, we see a mix of both opportunities and challenges. On the generic formulation side, we expect a sustained performance supported by a gradually improving environment in the US market. On the API side, we anticipate some recovery. However, pricing pressure and higher inventory stocking at our customers could impact offtake. The recent and successful outcomes from inspection of 2 of our sites by the US FDA reiterates our commitment to quality excellence as we continue to work on strengthening our mid to long-term proposition with increased investments in portfolio, R&D capabilities, and infrastructure to deliver on our strategic plans. Moving now to Biocon Biologics. Let me start by providing an update on the transition of the acquired business from Viatris to Biocon Biologics. Our accelerated integration plan has been progressing well. In addition to the 70 emerging markets transitioned in July, we have now fully completed the integration of the North America business, resulting in seamless commercial operations in the region from September the 1st. We remain on track to transition the business in Europe, Japan, Australia, and New Zealand, and the remaining emerging market countries later during the year, which will complete the integration of the acquired business. The transition and integration of the 2 businesses is a critical milestone in our journey, as it enables the most important strategic rationale of the acquisition, and that is the creation of a globally scaled and fully vertically integrated lab-to-market biosimilar enterprise. Turning now to the business performance and starting with the United States, we continue to see good momentum across our oncology and our insulins portfolio. Fulphila, our biosimilars pegfilgrastim market share, has grown to 19% in September versus 11% last year. Market share for Ogivri, our biosimilar trastuzumab, stands at 12% versus 10% last year. We continue to add new customers for these products. A large benefit provider covering 100 million lives has added Ogivri and Fulphila to their 2024 medical drug lists, enabling further market share growth in the coming year. Market share for our insulin glargine is at 11% in September. The volumes supplied through a large managed care network contract, not captured in these market shares, is over and above the IQVIA data. Furthermore, starting in January the 1st, 2024, we have added 2 large payers to our insulin glargine customer base, which should help further enhance our market share. These strong market performances of our products demonstrate the commercial capability of our US team, and continued addition of new customers for these products enables volume growth, accommodating for price erosion. Turning now to adalimumab, the market adoption of biosimilars has very clearly been slower than anticipated across the market, and of course this has also affected Hulio, our biosimilar adalimumab. Notwithstanding these early market dynamics, our focus remains on expanding market access to drive adoption. We remain engaged with customers to add our product to their formularies, and I'm pleased to share that our product has been enlisted with the commercial standard opt-out formulary of a large purchasing organization and corresponding managed Medicaid business, covering over 8 million lives. It has also been added to the National Preferred Formulary for Medicaid members, one of the largest Medicaid managed care organizations, covering 7 million lives. Turning now to Europe, our products continue to make steady gains. The market share of Fulphila has grown to 8% against 5% last year, and Abevmy, our biosimilar bevacizumab, has grown to 7% against 1% last year. Hulio continues to have market shares of 18% and 11% in Germany and France, respectively. As we complete the transition of the business in Europe to a single fully integrated model, we see the potential to improve business performance. In emerging markets, Biocon Biologics remains on a steady growth trajectory supported by continuing strong demand for insulins. We continue to increase the depth and breadth of our emerging market franchise. In Q2, there were 4 new launches and 11 new approvals, laying the foundation for future growth. Aligning with our global product focus, we announced the divestment of 2 non-core branded formulations, India business units in dermatology and nephrology to Eris Life Science for 366 crore, representing a revenue multiple of around 4%. Now coming to the financials of Biocon Biologics. On a sequential basis, we have seen revenues marginally down by 2% at 1,969 crore, despite significantly lowering licensing revenues versus last year. Excluding these licensing revenues, sequential growth stands at 6%, reflecting the underlying positive performance of our commercial products. This is translated into a core EBITDA of 660 crore, with margins at 34%, in line with our mid-30s guidance. EBITDA margin for the quarter was 23%, with R&D investments at 11% of revenues. Profit before tax stands at negative 15 crore, driven by an increase of 35 crore in depreciation, amortization, and interest costs. PBT is expected to improve with future growth in revenue. Now moving on to regulatory updates. The European Commission has granted marketing authorization in the European Union for Yesafili, our biosimilar aflibercept, indicated for macular degeneration and diabetic retinopathy. As per IQVIA, aflibercept had EU brand sales of approximately $1.8 billion last year. The US FDA has issued a CRL for the BLA of our insulin aspart, which did not identify any outstanding scientific issues with the product and references the requirement for satisfactory resolution of deficiencies from the pre-approval inspection of our Malaysia facility. Separately, the FDA conducted a CGMP inspection of the Malaysia facility in July 2023, leading to observations primarily related to enhancing operational procedures and strengthening training programs. We are fully engaged with the agency to resolve all outstanding concerns. In summary, we are pleased with the accelerated program transitioning the acquired business and with the growth in market share of our commercialized products. While there has been delay in the activation of our immediate near-term catalysts, biosimilars, adalimumab, aspart, and bevacizumab, these remain to be future growth drivers. And beyond these, and reflecting the strength of the Biocon Biologics pipeline, other future growth catalysts, including biosimilars to aflibercept, ustekinumab, denosumab, represent total original sales opportunities of $25 billion in sales. Turning now to novels, and on the novel side, Bicara recently presented updated and positive interim data from its ongoing open-label phase 1/1b dose expansion study of BCA-101 at the European Society for Medical Oncology ESMO Congress. There was strong investigator interest shown for these data. And Bicara is now well positioned to execute on its next round of funding, advancing BCA-101 and progressing its pipeline. To remind you, Bicara had announced a US $108 million Series B financing earlier this year, which is being realized in a staged manner. Because of this, during the quarter, we recorded a step-up gain of 75 crore in the consolidated P&L statement. Turning now to research services. Revenue from operations for the quarter was up 18% to 910 crore over last year. Reported EBITDA was up 19% to 276 crore, with an EBITDA margin of 30%. Profit before tax was up at 158 crores, 22% over last year. The performance during the second quarter was bolstered by strong performance in development and manufacturing services and supported by sustained momentum in the dedicated centers. In manufacturing services, Syngene continued to make good progress on the long-term biologics manufacturing partnership with Zoetis. So coming now to some concluding remarks, and I think that overall we are very pleased with the progress the group has made in the quarter. Biocon Biologics is on track with its accelerated transition program to create a fully integrated and globally scaled leading biosimilars enterprise. This will advance our ability to leverage the benefits of the fully integrated model and to expand our footprint in the United States, in Europe, and the most of the world markets in addressing the growing global demand for biosimilar products. The sustained momentum we've seen in the market share gains with our commercialized products in the United States and Europe as we complete the transition demonstrates the effectiveness of our commercial engine. As well as driving currently commercialized products, this provides a strong foundation for our future as we look to bring to market a rich pipeline with new product launches planned almost every year through to 2030. Finally, and looking ahead to the full year, we remain on track to deliver 1 billion revenue for Biocon Biologics, mid-teen constant currency growth in Syngene, and an improved second half performance in generic. That concludes my opening remarks, and before I hand over the floor to questions, let me end by wishing everybody a very happy Diwali and all the very best for the year ahead. May I now turn the floor over to questions.
Thank you, Peter. We'll wait for the question queue to assemble. Ladies and gentlemen, please use the raise hand icon in the Zoom application, and then we will take the questions once the queue is assembled. First question for this evening is from Dhaval Bhalodia. Please go ahead.
Hi, and good morning, everyone. Myself, Dhaval Bhalodia. I have a question regarding the U.S. biosimilar industry landscape. Currently, there is three largest PBM and specialty pharmacy holder majority share in the biologic product market. And our brand Julio is one of the formulary and one of these largest PBM. However, this particular PBM is planning to introduce their own biosimilar brand in collaboration with Sandoz. So given this competitive landscape, I'm curious to understand the strategic approach we are adopting. Could you please shed some light on what strategy we are implementing to navigate this competitive environment? And how we anticipate the sale of our Julio brand to fare in the year 2024?
Peter? Oh.
Yes, do you want to take that?
Yeah, thanks, Peter. I think, thank you, Dhaval, for the question. And I think between Matt and me, we'll respond to your question. Maybe, Matt, you can start and then I can add to this. Do you want to go ahead?
Yeah, sure, Shreyas. Thank you. Thanks for the question. I think, as we continue to watch the evolvement in this whole biosimilar industry as it relates to adalimumab and our Julio product, this is a significant, what I would call, change, but one in which it's not the full portion of everything that we see in the market and the opportunities. This is a position in which a large payer has taken, but it's still playing out. What we've seen is them announcing this. We have not seen the large player now start looking at all formularies, both commercial and non-commercial formularies. So we continue to look at our biologics and our platform in regards to the total market itself as it relates to adalimumab and Julio. And we're seeing good progression in what we call low-cost sensitive payers. And so just because they've announced this on the commercial side doesn't limit us to playing in the rest of the full market. So we're going to continue to watch how this plays out with the company you mentioned and the third party that they have set up. We have been in active discussions with them. We do understand exactly how this market is shaping up. And I think, in my opinion, it's something that we need to continue to focus on, but not something that would limit us to the rest of the market as we go through this. And remember, biosimilars, it's just not an exclusive. Most of the payers will be looking at this, we believe, going forward in a situation where they won't have just one biosimilar. Once the Humira, when the payers decide what they're going to do and release this, we believe the market will reopen up again and there'll be opportunities no matter what certain payers or partnerships are looking like. So we remain positive for the future and how we're looking at our products, especially our Julio products. So I'll turn it over to you, Shreyas, for some additional comments.
Thanks, Matt. I think the only point I'll add to what Matt said was these are strategies that payers will come up with, and I think we will respond to these as the market progresses. Just want to point out that the payer that you referred to also has formularies outside of commercial, and those would be in the managed Medicare space and the Medicaid space, and you've seen our product being listed on those. So you will see outside of the particular collaboration that you pointed out, payers, the same payer making selections depending on what prioritizes their decisions on those formularies. So as Matt said, we are aware of these things, and we remain in connection and contact with customers, engaged in seeing how these decisions are made.
Okay, thank you. And my second question is, there is a couple of concerns recently come out due to the current environment. Firstly, with the 85% of the price erosion on the biosimilar product compared to the brand, in case of the in case of the Humira, and secondly, the higher interest cost on our current debt in the prevailing high interest rate environment. So I just want to check. I know this is a current, just recently came up. This was not the case at the time of the Viatris acquisition, but I just want to check whether this negative factor was adequately considered or factored into the decision making process during the Viatris acquisition. And it would be helpful to know if our current debt has a whether fixed or floating interest rate structure, and if we hedge our interest rate exposure to for our debt. Thank you.
Thank you for the question there. I think perhaps, again, Shrihas, if you'd like to address the first question, and maybe Sid, you can address the question on interest rates. Or Chini.
Yeah, I think Chini can address that as well.
Yeah. I think the question, Dhaval, is very valid. I think from the time we've announced the Viatris acquisition back in February of 22, obviously things have changed and interest rates have revised overall. As Peter mentioned, even in his opening remarks, we've seen adalimumab behave differently in terms of the slower ramp up than expected. We had obviously guided for a slower 2023 with pickup beginning in 24 and 25 being the real opportunity. Things will probably play out in that manner, but 23 has been slower than what we had initially planned. So to that extent, you're right, the things have moved a little bit, but the opportunity remains intact. And this moves by a couple of quarters into 2024. To your question on what these interest rates have been and how they've moved, I'll defer to Chini. Chini, do you want to take that up?
Yeah, hi. So as far as the 1.2 billion loan is concerned, we had kept 1/3 open to allow for early prepayment. 1/3 has been hedged, and 1/3 is open for interest rate movements. So that's how we managed the.
So it provides for enough flexibility to accommodate for how we're moving forward, Dhaval, if that's what you're looking for.
Okay, that's it only for my side. Thank you so much.
Thanks, sir.
Thank you, Dhaval. The next question is from Yashtana.
Yeah, good evening and thank you for the opportunity. So my questions are, I'm trying to understand the PBT number for Biocon Biologics. So last quarter, we said that there is a one-off 15 million expense due to the legacy contracts. And before that, I mean, if I add that back, and in Q4, we did about 150 crores. So I'm not able to understand, even with a 35 crores increase Q1Q, the number on the PBT side.
Again, I think that's a Shrihas, Chini.
Chini, why don't we explain this to Yash, and then we'll walk him through. I think we've had a healthy performance on the business and how the PBT is impacted. Maybe you can explain that too.
Yes, hi. As you noticed, that there's been a strong improvement in our core EBITDA performance for the quarter. We've moved from 513 crores to 660 crores. With the EBITDA is kind of flat at the 450 mark, 457 in Q1 and 453 in Q2. And that's largely because Q1 had a benefit of licensing income, which played out, and that helped improve the core EBITDA. Improve the EBITDA for the quarter. This quarter, you've seen strong sales performance, no licensing income or meaningful licensing income, and EBITDA is back up at 450 despite no licensing income. And as I indicated earlier, the strong performance at the core EBITDA line. When you go to the PBT line, we've kind of moved from plus 24 to minus 15, and that's largely because of the increased amortization cost consequent to the launch of Hulio or biosimilar adalimumab in the US. So there's a need step up or increase in the amortization charge.
So got it. And my second question is relating to the growth, at least in the near to midterm, with observations on the Malaysian facility. As part, I believe, is not. Are we anticipating this for FY24? And if not, how are we planning to grow above the 1 billion base that we had target that we had set out, at the start of the year?
Let me respond to that, Yash. And I think from Aspart perspective, I think the development has been positive in terms of the engagements that we've had with the agency, and we will be in active engagement with the FDA early next year. So once we have clarity on what exactly it is that they expect you to do, we will be able to give you more color in terms of when that opportunity realizes, whether it is early 24 or it's later. But I think it's important to see what the growth drivers were when we began the year. We exited Q4 of last fiscal with an exit run rate of $1 billion, and we were looking to grow that business with the growth drivers, particularly driven from the commercial products. And as you heard in Peter's opening remarks, almost all, or not almost, all of our products have grown in market share over last year. So one of the most reassuring things is in the major geographies, both in the US and in Europe now, we're seeing very strong growth in all our commercial products. Now, as US still moves on with this approvals with the FDA, one of the important things for commercial products is we've got 7 products approved in the EU, and adalimumab has done well in Germany and France, but we have a lot of headroom in the other products where we could grow from the base that we've got. And we're starting to see that with bevacizumab, which has moved from a low base of 1% to 7%, and we're starting to see that in other products as well. So clearly, there's an opportunity to grow from the base that we exited last year, last fiscal, to where we are now. We also do look forward to the opportunities with Folio. Like Matt said, we haven't given up on that, or it's not a closed opportunity. We believe that this is an opportunity which is intact, but just shifted at this point in time. And as payers and as markets outside of the commercial channels open up, we will look at that also driving growth into calendar 24. So that's where we are in terms of where we see this growing from the base that we exited last fiscal.
No, sir. Got it. Thank you, and happy Diwali to you, the team, and the best of luck.
Yash.
Thank you, Yash. We'll take the next question from Surya Patra.
Yeah. Hi. Thank you for this opportunity. My first question is about the like-to-like growth that we would be seeing in the biosimilars operation. So, in fact, the specific question is that we have seen a kind of a good ramp up and good adoption of our biosimilar by payers in the recent period, and also the integration has provided some kind of additional foothold in the US market, and simultaneously we have seen some kind of or incremental pricing pressure for the biosimilar. So net, if we see, we have YOY basis has almost double in terms of reportable revenues in the biosimilar business. But is it possible to share what is the like-to-like growth that we would have seen? And the extension to that is that, see, whether we are doing better in the non-US market compared to the US market at the current juncture, if you can share that.
Yes, I think again to you.
Yeah, thanks, Peter. Surya, I think one of the things that we've not done so far is give product by product details. So that's something that we've not disclosed at this point. I think one of the things when we look at better, over last year, and we see almost all geographies performing better over last year. We've put out the major geographies in the US and EU by product, and we've shown that growth in terms of how we've performed over last year. So I think it's been a very clear pattern that in the US all products have performed well, and we are seeing that growth across the EU as well. So we are seeing that move up. Price erosion, as I've said, even in the past, is an outcome of competition. So that's something that you will continue to see, and that's where volume growth is extremely important. So these market shares have come at a stage where we've looked at preserving ASP. So we haven't gone chasing market share at a crazy ASP. So we've been able to preserve value and build those market shares in a very steady, measured manner. So it's grown over time in a profitable way as we've offset the price erosion that's happened over the course of time. But to go and look at every product by geography, that I don't think we've shared those details so far.
Okay. In fact, the basic point I was trying to draw from my question is that, see, the spend on the US biosimilar is obviously significantly higher compared to the emerging market. Basically, we are utilizing the same dossier for the other market, non-US market. And non-US market, it seems, grows better or growing better than the US market at the current juncture because of branded play and all that. So my sense is that, see, unless until we cover up the R&D spend, the incremental R&D spend after the integration of Viatris operation, what we have seen from the incremental US revenue, we may not see much ramp up in the or improvement in the margin profile. So that is why I was trying to assess that whether the current performance has been supported by the non-US market, which is branded business growing relatively better compared to US, but US possibly will see the ramp up only after the commercialization of the pipeline products.
Srini, do you have any additional color for Surya in terms of the margin profile by regions?
So, hi, Surya. We don't disclose margin by geography or product. Right?
Sure, sir. Okay. My next question is on the large Medicare or payers that we have seen as or the large Medicare payers that those who have adopted our products in the recent period. So with that, what is the kind of theoretical market share that we can see for our glargine as well as Herceptin?
Matt, you want to go ahead with that?
Yeah, I'll take it, Shreyas, and then I'll pass it over. Look, as I think what this demonstrates is good demand for Biocon Biologics products. As we bring on these new payers, certainly we are looking for that market share increase, and we anticipate that. But right now, to say exact numbers, it's early. All we know is what Peter had highlighted in his opening comments, is that we have two significant payers that will be starting at the first of the year or have started, that will be a nice contributor to our insulin franchise. And then also we continue to see additional traction, and this is what we're excited about in North America, additional traction in our trastuzumab, in our pegfilgrastim, as we continue to win those payer awards as well as adding new ones. And then we've also seen, as Peter said in his open comments, some nice wins in regards to our adalimumab and our Hulio. So to say exactly what those market shares will be, it would be hard to project, but we are anticipating that growth because the additional wins and the demand for our products across the board, whether that be in our insulin or oncology or even in our immunology. So I think it shows and demonstrates, as Peter and Shreyas shared, as we're cutting over And we say this, and I've said it before, biosimilars is not just what we do, it's all we do. And I think that's really the focus that allows us to continue to see this progression, as well as our manufacturing and our vertical integration to continue to compete. Lastly, I'll say across our products, and why I think we continue to see this uptake, is that they come back in, but we are dedicated to the market. And I think that shows in our value to our customers, and also the ability to maintain the products that are needed for patients that rely on all of our products, and our commitment to the market, both in North America and Europe. As you can see, market share continues to increase there.
Sure, sir. Just with your permission, one last question from my side related to the regulatory compliance related development. So my sense is that insulin aspart possibly was the low hanging fruit on that regulatory compliance or advancement front, and subsequently we were thinking about the bevacizumab linked to the Bangalore site. So is it fair to believe so with the CRL what we have achieved for now Malaysia site, so the development of this bevacizumab and the plant related development regulatory in the Bangalore site will only happen post Malaysia plant's clearance, or both are happening parallelly?
Surya, let me respond to that question. The aspart CRL is an independent issue from the current status that we have with the FDA at this point in time. The aspart CRL is an outcome of the inspection that we'd received in August, September of last year. And they had already accepted our CAPA. They found it to be adequate. And they had written to us that they would need to verify the completeness and the effectiveness of those CAPAs when they do that in a follow-on pre-approval inspection. That inspection was to happen before the goal date in October of this year. That pre-approval inspection was not scheduled. So the aspart PI is linked to us having that inspection yet, which has not been scheduled. The status in Malaysia is linked to the surveillance GMP inspection, which was scheduled for products approved and commercial, which was not related to aspart at all. So these are two de-linked activities. And as far as India's site is concerned, we continue to supply the commercial products. The pre-approval inspection is for bevacizumab, for additional capacity, and for trastuzumab. So those are different requirements. And at this point, we await that inspection, which is scheduled for Q4 of this fiscal year. Obviously, whenever you have a regulatory observation, you want to make sure that globally all your sites and all your networks benefit from whatever actions you take. And our quality team, led by Michael, and then our Chief Operating Officer, Rhonda, was also on the call. We've put in place a very comprehensive program to make sure that we've implemented these practices so that the agency continues to see the upgrades that we've made on our quality maturity journey that we have been on. Clearly, it's a step up in terms of what we are looking to do. And that's a process that's a part of our business, which we continue to invest in.
Sure, sir. Thank you. Wish you happy Diwali to the entire team of Biocon.
Happy Diwali, Surya.
Thanks, Surya. We have the next question from Janil Shah from JM Financial. Please go ahead.
Yeah, hi. Thank you for the opportunity. My first question is on aflibercept. So is there an update on the litigation? And if all goes well, when is the earliest we can launch this product?
So, Janil, as we've said in the past, the litigation update is what is as we've shared in the past. do not have any further update. The trials completed, and at this point, we await the decision from the judge to see what the next steps could be. That's where we are on aflibercept. In terms of launch date, I think at this point, since we are in an IP litigation, it wouldn't be fair to comment on what that would be.
Sure. And at the time of acquisition, there were certain deferred payments to be made in FY25. So, is it linked to any milestone, and what is the quantum payable and how do you plan to pay that?
Those are not, I don't think there's any milestone. Chini, is there any milestone linked to this? Not to my knowledge, Jen.
Okay, so but it is payable in FY25, right?
That's correct. Right, Chini?
Yes, it is payable in FY25.
And we'll be paying from our internal accruals, or we'll be raising money for that?
Combination, we are looking at, we have different ways to pay down the deferred payments. Largely, yes, internal growth, and we could have some other fund flows that we plan for.
Okay, and just on the filing status, so we were supposed to file Stelara by this year and denosumab by next year, and Humira interchangeability. I think how are the trials progressing?
So, Daniel, just happy to share with you that we are on track for both ustekinumab, which is before the end of this year, and for denosumab also end of next year. So that stays on track, and we have passed the trial, but we of course talk about it only once the applications are made and the dossiers are submitted and accepted by the agency.
Okay, that's all from my side. Thank you and happy Diwali.
Happy Diwali.
Thanks, Janil. We'll take the next question from Nithya Balasubramanian from Bernstein.
Yeah, hi, thank you. First question is on glargine. You had alluded to 2 new payers now adding glargine in their formulary. If you can tell us what number of commercial lives, or I'm assuming it's commercial, but what number of lives that it represents?
Yeah, I would say at this point, so hopefully you can hear me, sorry. This point, this remains confidential on these lives, but I can tell you they are large payers, and why it remains confidential, we're still on track to be able to announce this, but at this point, we are not disclosing that.
Understood. You had spoken about a managed care organization where you were expecting to see better traction in insulin glargine this year. However, if I look at the data, I'm actually seeing slight slippage in market share. So what's happening there? Why haven't we seen that progress?
Yeah, Shreyas, would you like me to answer?
Yeah, I think please go ahead.
Okay, yeah, some of this, the IQVIA data, there are some large payers, closed door networks that don't report. So you're seeing some quarter over quarter buying patterns, but you're not seeing the full picture because of the way folks in IQVIA report or don't report. But we continue to, as Shreya said, maintain that mid to high teens. And I think with the new large payers coming on board, that definitely will be something we'll be able to hit that target with.
Just one to add, Nithya, to what Matt said, when you have a closed door network, like Peter referred to also in his opening remarks, when they do not report in the IQVIA data, one of the good things about this is it's an exclusive channel, which also sees a very high degree of conversion to the brand. So it straight away comes to Semglee or insulin glargine with an over 95% conversion in a quarter's period.
How do you see the adoption of GLP-1s impacting insulin volumes? Do you see that as a mid to long-term threat?
We see this as at this stage, and again, this is just to be qualified appropriately, but we see this as complementary treatments, things that will coexist over a period of time. And I will defer to Peter. Peter, if you would want to give a overarching view on GLP-1s and insulins together.
Sure. So I think you shaped the nature of the answer, Shreyas. I mean, I think they would be complementary. Insulins would be obviously for type 1 diabetes, GLPs would be more to the type 2, and of course, beyond that, the weight loss opportunity. And this talks to, the investments that we're making in the generics business in building a peptides technology capability and capacity to take advantage of what could be a very, very strategic peptide opportunity with GLPs at the center. Analyst estimates of what the loss of exclusivity for GLPs could look like over the next 10 years, hover around the $100 billion mark. So that's a very big opportunity for the generics business and very complementary to the biologics business with insulins.
Got it. Thanks. And if I may, any updates on your interchangeability study for adalimumab? When might you be expected to file the product? And for Stelara, again, would you again be going after interchangeability? We know that a peer has now has an interchangeable designation for their biosimilar.
So two things on the adalimumab study, we've already said it's underway, and we should have the outcome to discuss in the coming calendar. So that's one. On the Stelara piece, we feel quite confident on the interchangeability discussions. We're starting to see that come through. The agency believes that can happen, and we feel very strongly about that from our product, for our product as well.
Sorry, Shreyas, do you mean an interchangeability designation for Stelara without doing a switching study, or?
So we don't want to disclose the specifics of our strategy, but we feel good about how our interchangeability should work.
Thank you so much.
Thanks, Nitya.
Thanks, Nitya. The next question is from Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah, good evening, and thank you for taking my question. Just want to reflect on the last 12 months from a Biocon biosimilar perspective. I remember when we were talking about the acquisition, or even in the first quarter of the acquisition, we were talking about this $1 billion run rate. We are talking about the same $1 billion run rate for this fiscal as well. So just want to understand, has some of those pieces, which are the pieces that we think they did not materialize for us to see growth over a 12 or a 15-month period? Right? And underlying profitability for the business, I remember at that time was roughly 25% is what was, kind of thought of. And I'm including R&D, not looking at core EBITDA or something. Net debt to EBITDA at that time, it's probably looks like now closer to between 4 and 5. What are the plans for us? If you remember, as cash flows get generated, we wanted to pay down debt. So just the overall piece of doing the transaction at that point of time and 12 months out, how does it look? And which are the pieces that are probably not working, maybe which are working?
Let me take it, Peter. Is it okay?
Yeah, please do, Shreyas. I'll comment at the end.
Okay, Shyam, I think that's a very fair question in terms of where it is, and I think you're right. Some things have worked well for us, and some things have not gone well. And it's not just gone well for us; probably not gone well even from an industry perspective. So more like a class effect. From what's gone well, we've talked about it, where we've seen that off the base that we came off from last quarter, last year, we've been able to do what's in our direct control, where we've been able to gain market share as we've transitioned that business sooner than what was there. So we are more in control of our destiny than before. So in terms of value, more than 50% of the value of the business is now transitioned to Biocon Biologics. So these are all the good things that's allowed us to gain control of it. So it, things like what surprised us and what didn't go well, in terms of the legacy contracts that led to rebates, which we had to accommodate in the P&L, some of it which hit us in a big way from a quarterly perspective. We have a better control on that now. The growth drivers that we looked at have certainly deferred. So what didn't work very well has been the Julio launch, which we expected on July 1. We were able to launch the product as planned, but from an entire industry segment itself, none of the biosimilars have been able to win market share in 2023. And I think that's something that's to be looked at, because the opportunity moves and remains intact at this point in time. We have some work to do because we've taken over the business post the launch. But we will, our teams are working and engaging with customers to see how we can get into formularies, because that's an area that we haven't been successful yet. So clearly, we are doing that for the commercial formulary. Aspart is something that has indeed surprised us. The pre-approval inspection, we believe that we have a very strong quality management system in place. But of course, given that we've got approvals in almost every other geography, but we still have to win the confidence of the FDA. And at this point, that's the process. And we're just going to be working to see how we can win credibility with the agency. We have approvals with EMA, with Health Canada, TSA, Anvisa, Cofepris, you name the agency. But I think what's not gone well for us yet is that we haven't been able to get across the line from an FDA perspective. And that's something that I can tell you our entire leadership is focused on, and we should see success sooner than later because of the efforts that we are putting in and the discussions we've had. So I think if you do a full SWOT of it, there are things that have gone in our favor, and there are things that we could have done better. But the important thing is that these are opportunities which have shifted, and we believe they're still to be realized in the coming quarters. But I'll pause and I'll see, Peter, if you wanted to add something to that.
Sure, thank you, Shrihas. I think the only thing that I would add, because I think you've given a very comprehensive answer, is the progress made in the transition, as Shrihas alluded to. We have not yet got our hands around 50% of the business, only just in the United States. So it's not steady state. We're going through a complex transition, and we're doing it in a accelerated, shortened period of time. And there are a lot of things that we need to do. Shrihas has alluded to very many of them. And again, I think the entire team is focused on, navigating through the transition, getting our hands around the full business and our hands on the steering wheel. Once that integration is complete and we've consolidated, as I think many of the questions have provided pointers to, we see a very healthy growth future ahead, driven by the market share gains where we've got in the commercial products. Of course, those are offset to some extent by price declines, but by a very healthy pipeline that once we get through the FDA discussions, augur well for the future. So it's not, I think, the right way to look at this as steady state at this point in time. I think another 2 quarters and we'll really have gone through the integration and consolidated, and then we'll be steady state and have the kind of trajectory that we're looking at.
Got it. Very helpful. Just the second question to Siddharth on the generic piece, right? I think API business, I think you mentioned there were pricing pressures, muted growth. I think one product where you have taken, a pause perhaps. So just want to understand what's happening there. We earlier had some guidance for generics, but looks like we've not mentioned anything except that 2H will be better. So just that color on both API and formulations. Thank you.
Thanks, Shyam. Yes, we've had a H1 growth of 9% in the generics business. In Q2 specifically, we have also seen a very good growth on the formulations business, which continues to perform well. We continue to gain market share on statins, and we also expect to launch a couple of new products, and that's what is going to probably drive the growth in the coming quarters. Of course, it will take some time before we see this 200 crore odd number per quarter that we are clocking in the formulations business go up significantly. But on the API business, the reasons you mentioned, we have one of the plants which underwent a planned shutdown And hence, there were capacities that we could not manufacture, and we expect to cater to that customer's demand in the coming quarters. So it's just moved to the next quarter. And but at a macro level, when I look at, there has been an impact seen as a result of the pricing pressure that some of our customers have faced, and either they've asked for much lower prices, which we are not able to cater to those demands at that price, or our customers in certain cases have lost the business that they had with their customers, their end customers, and which has led to lower offtake. Directionally, I do not see a huge change for the kind of products we have, the genericized products, in the coming quarters. Of course, a lot would depend on as and when we launch new products, especially the peptides in the coming quarters, and that's where we'll see a growth kicking in to that mid-teens level in FY25. So for H2, just to reiterate, H2 will be better than H1. We will see a steady performance of formulations at the level at which we had in H1, which is around 400 crores. And H2 API business should pick up compared to H1, but on an overall basis, the guidance that I had given last year of mid-teens might be more titrated down to low teens to high single digit.
Got it. Thank you, and all the best.
Thank you.
Thank you, Shyam. We have the next question from Mr. Rumel Dahiya, a retail investor.
Thank you, Mr. Paliwal, for giving me this opportunity. I speak as an investor, a long-term investor in Biocon, and with a large number of concerns to share. I have been on social media. I have been interacting with the chairperson. She has very kindly been replying also from time to time, also with your investor relations team. But I thought the concerns are still not addressed. I thought they would have been addressed in the presentation by Mr. Baines, but no, they were not. So I thought, let me just bring them up front. And I have a couple of questions. I'm sure you'll accommodate me for this. My first question is, has there been an analysis, the cost-benefit analysis, or let's say the opportunity cost that we have lost because of poor inspection record, particularly in our Zohar Baru plant? And has there been anybody held responsible for that loss that has been caused because of poor things like sterile seizers not being there, or an exhaust pipe being blocked, and things of this nature? If we take pride in